What's up, everybody? Is the housing market sinking? According to Fortune magazine, 16 markets are going down while 23 others may be spared. Let's see which markets they think are going to crash and which ones they don't. So let's just dive right in. Last week, Lambert posted an article on Fortune showcasing which markets they think are the most vulnerable to a housing crash. As we know, rising mortgage rates along with rising prices have caused the housing market to start correcting. The Fed Reserve has intentionally driven rates up to combat inflation, and it's working. The housing market is very different than it was 6 months ago. Prices are going down and inventory is going up. But even with all that's happening, most housing economists still believe that we are not going to have a housing crash like 2008. Now, we can see that certain markets are already correcting. So which markets do they think will have the biggest price reductions? To find the housing markets with the highest risk of a housing crash, Fortune teamed up with Home LLC. So let's see what they found out. To calculate the risk assessment, data scientists at Home LLC worked with Fortune to build a forecast model using 14 metrics, including building permits, land use restrictions, delinquency rates, housing inventory, and average home tenure. They looked at 100 of the largest metropolitan areas in the nation. Then they took them and put them into 3 categories: the highest risk, the moderate risk, and the lowest risk. The housing markets in the high-risk category are the most vulnerable to a housing crash. Among the nation's 100 largest housing markets, 23 markets fell into the low-risk category, 61 housing markets fell into the moderate-risk category, and 16 markets were labeled high-risk. This is a sizable shift since last month. Back in June, they labeled 37 markets as low risk, 52 markets were labeled moderate risk, and only 11 markets were labeled high risk. Let's take a look at the map provided by Fortune and Home LLC. It looks like they labeled the DC area moderate risk. I think this sounds about right because in my area, some houses are seeing a big price reduction while others are still getting multiple offers. Just depends how they're priced, what the condition is, and honestly, which neighborhood they're in. If they're in a more highly sought after neighborhood and they're priced right and in good condition, I'm still seeing multiple offers. But I am seeing more and more price reductions around the DC area. So moderate risk sounds about right. But check out Florida. 8 out of 16 of the high-risk markets are located in Florida. Those high-risk Florida markets include Cape Coral, Deltona, Jacksonville, Lakeland, Miami, Northport, Palm Bay, and Orlando. Nik Shah, the CEO of Home LLC, told Fortune that most Florida markets face a significant risk of oversupply. He goes on to explain that as the housing boom started during the pandemic, home builders across zoning-friendly Florida ramped up their production. So now the elevated home building levels makes Florida a higher risk of oversupply. If home sales continue to go down, this oversupply of inventory may be too much to sustain. Lambert writes that oversupply scenario, of course, is how markets like Miami, Las Vegas, and Phoenix got hammered so hard back in 2008. Let's go back to the map and see the other high-risk housing markets. Fortune and Home LLC put both Phoenix and Boise in the high-risk category. Both of these markets flourished in the last 2 years because a lot of tech people from Seattle and San Francisco moved there because they could work from home. As Lambert notes, there is a lot less of that now. Recession fears coupled with spiking mortgage rates have put cold water on those work-from-home moves. The other threat that's noted in this article for these high-risk markets has to do with investors. Over the past 2 years, markets like Atlanta, Jacksonville, and Phoenix were bombarded with interest from investors. Everyone from mom and pops to institutional buyers. On the way up, it helps. But as things slow, those investors could put downward pressure on home prices. Well, this makes sense because investors, unlike homeowners, make decisions based on business statistics. They're always weighing their profit and loss. When a market is hot, they buy as much as possible. When a market cools down, down, they may decide to get out of it quickly. John Wake, an independent real estate analyst based in Phoenix, said, if Phoenix real estate isn't the cool investment anymore in 2022, it could have a big and quick impact on home sales. If a lot of investors decide to sell, yikes. As we all know, if we get a great influx of inventory at the same time, this will cause prices to go down, especially with the higher interest rate and the priced out buyers. According to Realtor.com's latest data, active inventory continued to grow, rising 28% above 1 year ago. Fortune reports that between January and June of this year, US inventory climbed 51%. In places like Austin and Boise, inventory jumped 122% and 161% respectively. Ollie Wolf, the chief economist at Zonda, told Fortune that he doesn't believe we're going to have a crash like 2008 due to the stricter lending standards. However, he says, we can't ignore that the markets are already correcting. Higher home prices and higher mortgage rates rose to the point that demand seized up in many parts of the country. Home prices are already adjusting down, and we could see that continue until consumer confidence and affordability are reset. It seems that most of the economists can agree that overvalued markets like Phoenix and Austin have already entered into a home price correction. Moody's Analytics predicts that they can see that prices may fall in those markets by 15 to 20% if a recession hits. So what are you seeing in your neck of the woods? Are you seeing a lot of price reductions? If so, by how much? Comment below and tell us where you live. Last week, Redfin came out with their latest housing market update, so let's take a quick look. Daryl Fairweather, the Redfin chief economist, said inflation and high mortgage rates are taking a bite out of home buyer budgets. Few people are able to afford homes costing 50% more than just 2 years ago in some areas, so homes are beginning to pile up on the market. As a result, prices are starting to come down from their all-time highs. We expect this environment of reduced competition and declining home prices to continue for at least the next several months. According to Redfin, on average, 7.1% of the homes for sale each week had a price drop, a record high as far back as the data goes, back to 2015. Other indicators of the current market are the following. Fewer people searched homes for sale on Google. Searches during the week ending July 9th were down 5% from a year earlier. The seasonally adjusted Redfin Homebuyer Demand Index, a measure of home buying requests and other home buying services by Redfin agents, was down 18% year over year for the week ending July 10th. Mortgage purchase applications were down 18% from a year earlier during the week ending July 8th. Pending home sales were down 14% year over year, the largest decline since May of 2020. These indicators definitely show a slowing down of the market, but I don't think that's any surprise to any of us. I think that the buyers that remain active in the market are now waiting to see how big of a correction is going to happen. Even with the slight dip in the mortgage rates last week, I still didn't see a huge influx of buyers getting back into the market. But it is the middle of the summer, and around here in the DC area, the market tends to always slow down around now. So tell me what's happening where you live. Is the market slower? Do you think it's slower just because of the summer? Or do you know some buyers that are actually waiting on the sidelines, waiting to see how much of a price correction is going to happen? This is really important information, so definitely comment below if you are a buyer, if you know any buyers, and what they're doing in today's market and where they're located. I hope you got some value out of today's video. I really try to bring you the most up-to-date information so you can make the best decisions for you and your family. If you did get some value out of it, show us some support by smashing that like button, subscribing to our channel, and commenting below. It helps us with the YouTube algorithm and motivates us to make more videos. Thanks for watching. I do appreciate it. Bye!